Well, welcome to the fundamentals of real estate. I got a question for you today. Well, really, Glenn, how do I know when I'm ready for a reverse mortgage?
That's a great question. You know, one of the signs might be I still have an email address that ends in AOL.com.
Oh, I had one of those.
Yeah,
I did.
My happy
I
hours
was like
at
one of the first ones.
my happy hours at 2, and I have dinner at 4.
Or 3.
Yeah, 3. You know, it's funny. We're joking around about being old. I'm 62 years old. Technically, I'm eligible for a reverse mortgage, but I don't really feel that old. So, you know, age is relative these days. You know, there's a lot of people now that have a ton of equity in their house. They're retired, and maybe a reverse mortgage is right for you. So it's going to be fun today, looking at the requirements, what it takes.
We're going to get into the nuts and bolts as we continue our
how
series.
How it works, how I get one.
Yeah,
right.
how it actually works. So we talked about the 10 myths about it, and we talked about why it might be right, like why get one. So, you know, listen to last week's podcast. Yep. This is the nuts and bolts of it. So, Glenn, I'm thinking about getting a reverse mortgage, and I call you. What's the first thing that happens?
Yeah, the first thing is we're going to make sure that you're, you know, just some qualifying questions, that you're old enough, that you have equity in your house.
Wait, so I got to be how old?
62.
Okay, wait. What if I'm married and I'm 62, but my husband's only 60? And by the way, my husband's older than me.
Right.
So
well, you're still eligible. Either way, right. You're
so
still
only one of us.
One person has to be eligible.
Okay.
And you've got to have some equity in your house. We talked about this earlier. Maybe if I bought my house 2 or 3 years ago and I put down 5%, I'm probably not eligible. I need to have a significant amount of equity in that house.
Like?
Paid off 50, 60%. Okay. And I know that seems a lot, but you got to remember they're adding on to that every month. So they're looking for a lot of equity in the house. The good news is it doesn't take a lot of information for me to get you numbers to look at. So
so I call you.
Right.
You ask my age.
Right.
And then what's the second question you ask me?
What kind of vitamins you taking? No, I'm just joking. I'm not going to ask you about your vitamins. I'm not going to ask you about your insure intake.
Okay.
I want to know how old you are, and then I want to know the address of the house so I can kind of look up the value. You know, we go online, we can get some kind of idea. And really, that's all I need to put it into the computer program and give you some basic information. And that, what I'm going to give you right off the bat, you know, within 2 or 3 hours, is going to show kind of what you may be eligible for.
What I might be eligible.
Right.
So I get some sense of how much money the bank might give me. So
right, in the initial conversation, we're also going to talk about, and we'll go into detail this later, there's a bunch of different ways you can access that equity in your home. Lump sum, monthly payments, paying off the mortgage, all that. We're going to talk about that up front. So you review that information, and now you say, yeah, Glenn, this is interesting to me. I want to go a little deeper. I want to know what it would actually look like. I'm ready to apply for that.
Right. So when the numbers that you're going to give me, I assume that I have options about how I access this, because
you certainly do.
It's not monopoly money, right? And it's not free money, although it may feel like it might be free money, right?
Well, a few loans where you say the bank pays you.
Right. The bank pays you and
you
paying the bank. So I could take money monthly.
Right.
Right? And that would give me stability.
Right.
Right? I could
and we're gonna eliminate your mortgage payment, right?
Yes,
if you have one. Right, if you have one, if it's paid off, then you can take money monthly. You can take a lump sum up to, it's around 60% of the value and the equity that you can take the first 12 months. After the 12 months, you have access to the rest of it.
Okay, so I could take it in a lump. I can take it monthly.
Right.
Is there any other way I can take it?
Yes, you don't have to take it at all. You could have it just as a reserve fund or an emergency fund. It's a little expensive, you know, because you're going to pay the cost regardless. But the good news about letting it sit is it actually grows over time.
So the amount that I can access grows every year.
Right.
So, and the older you are, the more money you can access.
Right. But we're not going to look at
So I don't necessarily have to say, oh, I'm 62, I have to get it now. I can decide when I'm 70 or 72.
Right.
That this is what I need.
And there's an advantage. The older you are, the more they're going to be willing to give you, because you know the less time you're going to be accessing it.
Okay, and so again, why does this loan exist? Like, why would a bank want to give me this loan?
So these loans are not only by a bank; these are insured by the government. It's an FHA product, And
So
what it is,
it's
it's
a
way,
housing urban development.
Right.
It's a HUD product.
right, and another name for it is the home equity conversion mortgage. So it really isn't the
see.
bank giving you your money, it's you accessing the equity in your home over time.
Without a payment,
Right,
which
that's
makes
really
this
important.
different from a home equity. Because I
Yes.
could just go out and get a home equity,
can.
but then I'd have to make that monthly
Right.
payment.
And you have to
Which may or may
re-qualify
not
for it every
be
2 years, right?
Every 2 years. It may not be a fixed payment,
Right.
and it may not be a 30-year product either that you're used to.
Right.
But
And
this
there are
is
some-
going to be permanent.
Yes.
I can refinance it, right?
You
Like
can
I could
refinance it.
change it.
You
I could
can.
pay it off.
Just like any other
But
loan.
if I want to keep it, it doesn't. The terms are not going to change.
No.
And that makes it different than a home equity as well.
It really
right?
does. It's a lot more
Okay.
stable and secure, and not to have those
Okay.
payments. It's a lot of it's trading your equity for peace of mind and stability.
All right. So let's just say that I want to proceed. What's
Right.
my next step?
You're going to have to take a counseling class.
What?
Yes.
What are you going to dive into my childhood or something?
No, you're not going to lay on a couch. Not that type of counseling. This
Okay.
is an independent person that's going to make sure this counselor doesn't have any stake in the game, doesn't get a commission. You
All
pay
right.
a
Well,
fee.
what in the world do I need counseling about? I mean, I'm 62 years old. I know how to handle money. Why
So
do I need to be
These are
counseled?
complex products. It's not cut and dried. They're going to make
Okay.
sure that you understand the cost involved, how you understand the way it's paid out, the risk factors involved, the process.
Well, what's a risk? What am I risking?
You're risking the equity in the home. There's still a risk of foreclosure. You remember, you still have to maintain this property. You still have to pay the taxes and insurance on it.
Okay,
So
so
there
they're
is a
going to
slight
let me
risk.
know that I got to pay my taxes,
Right,
my
and
insurance.
they're gonna really, and I think the counseling, you have to pay this. It's typically $125 to $200 for this counseling fee. The lender can't push you towards one counselor or another, but they're really going to explain this loan in depth and look at all aspects. And it's not a salesperson explaining this to you.
Right, so it doesn't eliminate my taxes, my insurance, my HOA fees,
Right.
my flood insurance if I'm paying
Right.
flood insurance. It doesn't eliminate any of that.
It doesn't eliminate
Just
if
the
there's a hole in
mortgage
the roof.
payment.
It doesn't. If you
have to be able to maintain it.
Yes.
So they're going to explain that stuff to me.
Right. So you're done with the
Um,
counseling. Now we're going to finish.
And then wait a minute, and then they're also going to explain to me that when I get my initial loan, I'm approved for a loan.
Mm-hmm.
So let's just say I'm approved for $200,000 of equity out of my house,
Right.
and I choose to take it let's say $2,000 a month.
Right.
That my loan initially is going to be $2,000, and then $4,000, and then let's just say I
Right,
want
right,
$2,000 a
you're
month.
just
It's
adding-
$2,000
right.
plus interest. So let's just say the
So
interest
you're-
is $500 a month. Let's just say I don't know what it is, but let's just say then I get $2,000 a month, and I pay $2,500 because I have interest. It's probably higher than that. But then I'm going to go from $2,500 to $5,000 to
Right.
$7,500, right?
That's the equity
To
in the home that you're
$10,000.
using. Right.
I'm going to my loan balance is going to start doing that rising.
Right. And
So
there
it
a
is
limit.
in reverse.
Right.
This is different than when you get a regular loan and
Yeah,
you
a
pay
regular
it
loan, you're
down.
paying it down. This one, you're adding to
That's
it.
why
every
they
month.
call it a
Right.
reverse mortgage.
And even if you get to that level where there's no cash, there's still no foreclosure, no liability, because you can stay in that home forever. All the
So wait a
interest and
minute.
the
What
payments-
if I die,
Mhm.
and my spouse is younger than me and not yet 62 when I die? What happens?
So he has the right to stay in that house
Okay.
for as long as he's alive.
Okay.
And if he doesn't take any money, then that interest is just going to accrue. Or he can sell the
Okay.
house like any other loan. You pay off what's left, and you have the equity.
Okay.
Or you can just give it back to the bank and walk away,
All right.
and they'll deal with it.
All right. So I can be any age. I can be 90 years old and take this
Right.
out. Like they can't discriminate me because
They
I'm
can,
too
you
old.
can be 110. They can't.
All right,
discriminate
super
because you
good.
don't.
All right, so I make the application. What's involved there?
So the application, they're not looking at debt to income ratios. They are going to look at your assets, and they're going to look at your credit history to make sure that you have the ability to pay the taxes and insurance.
Okay.
And they
And
can
maintain.
the property. And they can, at their discretion, take part of that, and it's a big chunk, take part of that equity and set it aside to pay your taxes and insurance
And
for you.
if they feel like that
Right.
you're not in the position to do that, they want to make sure you are. They really don't want to take the house back from you.
No.
They want you to enjoy the house and stay there.
And there was a lot of criticism about this product
Mm-hmm.
when it first came out, because the misconception, well, I have a reverse mortgage, I can't be kicked out, and then it goes to the courthouse for a tax sale because I didn't pay the taxes for 3 or 4 years. So
Right.
that's why they've adjusted that, and it's really just to protect you and your heirs and protect
Okay.
them.
So I don't need a job.
You don't need a job.
You're not going to look at my income. What else are you not going to look at?
We're not going to look at your blood pressure. We're not going to look at your dental records.
Okay.
We're not going to look at your BMI.
All right.
We just want to make sure that this is a good loan and it's a fit for you.
Okay, great. Now, what happens next?
What happens next is hopefully we're going to have, just like any other loan, we're going to collect some documents from you. Assets are going to get a credit report, sign some disclosures, then it's going to go to a qualified FHA underwriter who specializes in underwriting these, and they're going to approve it with conditions. They're going to deny it, depending on the circumstances.
Well, are we going to get an
very
appraisal?
similar.
Don't we going to get an appraisal?
Oh, I forgot that. Yeah, sorry about that. So as soon as the counseling is done and you've signed the disclosures, then we're going to get the appraisal. And the appraisal is just like a regular appraisal.
So they're going to come out. They're going to take a look at my home. Can I get a loan even if I have my green avocado appliances still?
Then they might. Yes, they might say that it's dated because it has the avocado color appliances, which I happen to like avocado covered appliances.
You do?
I do. My wife doesn't, so our stuff is stainless steel.
Well, that's a good thing.
But
Lori has a way better taste than you.
Yes, they're not going to look at they're going to look at the condition of the property. So if there's peeling paint, there's defects to the property, those are going to need to be addressed.
So it needs to be up to an FHA loan standard, which is no peeling paint, no cracked windows. You can't have huge foundational problems or have a flooded basement. And so the house does need to meet a standard.
Right. And then that independent, unbiased appraiser is going to give us a value of the home too. And that's your age and the value of the home. That's what we're going to base the amount of equity that you have to access for this loan.
So you run the formula, and then you give my options.
Yes.
Right. And that's where you get really the details of what this is going to cost, what I can get, and how I can get it.
And one of the things that makes it expensive is FHA charges their 0.5% per month mortgage insurance, which gets added into the equity. They also charge a 2% fee, their mortgage insurance premium, up front based on the entire amount. So they assume that you're going to access all of the equity.
So if I was going to access $300,000, I would have to pay $6,000 up front at closing. So it does have some closing costs up front.
Yeah, they're expensive.
And it's not for everyone, obviously, but it does work for some people.
It does, yeah.
So I can get a monthly
payment. And the other thing I want to clarify, other than the counseling fee and the appraisal, which can be paid at closing, other than that, you pay nothing. So you don't pay the $6,000. They just subtract all that from the equity of your home.
So I don't have to have any money to bring in.
No money coming out of your pocket.
Okay. So I can either get these monthly checks to provide me some steady income. Right? Kind of like Social Security in a way.
Well, let's start. I would start off the basic. We can start off with eliminating the mortgage payment.
Yeah.
So if you have a mortgage payment, that's eliminated. So now there's more equity on that. Now we can access it in a bunch of different ways and a bunch of combinations of different ways.
Or I could get a lump sum. So maybe I had some huge medical expenses and I decided that this was the best way to relieve myself of them without a payment.
And we don't stipulate what you do with that money. I mean, you wouldn't want to go to the casino and gamble it, but you can invest that money. You can donate it. You can give it to your children to buy a home.
But I could pay off a huge bill.
Of course, yes.
Okay,
it's like any other loan. We're not going to tell you.
Or I could just set it up like a line of credit, which would give me flexibility in case I had a huge health debt or I just needed it for later in life when either Social Security runs out.
Yep, and if you're not,
or maybe my spouse is the one with the pension, and when the spouse goes, I don't have that pension anymore.
That's a great point.
That could happen, right? And so I would have this set up for the future.
It is, and if you don't access it, that line of credit is going to grow over time.
So it grows whether I access it or not.
And if you don't access it, you don't have to pay it back either.
Oh, I have to pay it back if I never use it.
If you never use it, then when you sell the house, you pay off just what you took out originally.
Wow. So I have options on how I can take it.
And that's a good reason for the counseling, too. That they're going to explain a lot of that to you in counseling. It's almost too much in our little podcast to talk about all the different combinations.
Right. Understood. Okay. So I get to figure out which option is best for me, and you'll help me, and you want to talk to everybody to figure that out, and then I just go to closing just like a regular loan.
Yep, just like it's not like it's different. It's a reverse mortgage. It's going to have some
I might be there all day signing. I'm just going to say it's probably the thickest amount of loan paperwork I have ever seen in my life.
Yes.
Is for sure. So you might want to,
Get
just
in
like
advance.
rest your hand. for, or maybe learn how to write your name with both hands so you can switch, be ambidextrous about it. I don't know.
But again, a lot of it is pure common sense too.
It is.
Yeah.
All right. Super good. All right. So I would, if you're thinking about a reverse mortgage, because you do want to stay in your home, you do need some economic stability for the rest of, the remainder of your life. Again, you can sell the house.
Of course.
Right, at some
Anytime.
point, pay the loan off, and your
heirs can sell the house.
Your heirs can sell the house. Now, again, it's a non-recourse loan,
right.
which means if I die and I have this reverse mortgage, my kids don't owe it.
No.
So if I owe more, if I end up owing more than the house is worth, they just give it back to the bank.
Right. And I think the bank gives you up to a year to decide what you want to do.
Well, and I do know that you have to. The taxes have to be up to date. HOA fees have to be up to date. The house has to be completely cleaned out.
And the other thing is you have to remain living in the house. So that's the question I get, what happens if I have a fall, I'm in a nursing home for 3 or 4 months and a rehab. They're not going to foreclose on you. You have to occupy the house at minimum of 12 months per year. You could have a vacation home and be gone.
Not minimum of 12 months per year, because 12 months is a year.
Right.
I mean, I can't be out of the house more than 12
consecutive
months in a year.
Thank you. Yeah, right.
So basically, 12 months. So if I'm out of the house for 12 months, then they're like, hey, you need to pay this loan off or give me this house back, basically, is what they're saying.
Right.
So can I rent my house out?
You cannot rent your house out. No.
It has to be my primary home.
It has to be primary.
Can I Airbnb it?
You cannot Airbnb it.
Okay, so there are some rules around it, which may
but
or may
you
not
can't
make
have
it
a vacation
ideal.
home in Florida, Colorado, whatever, where you winter and come back. So you're in the house for 6 months. You're in a vacation home for 6 months. That's fine.
Okay.
Yeah.
Well, that's super good. So sometimes you need a little extra, and you can pay it off at any time. Sell the house at any time, pay it off. Right. And take your equity and move on. Can I also then buy a house with a reverse mortgage?
Yes, that's a good point. Yeah, we've talked about that. So I've sold my house. I want to buy a new house, and it's a little bit more. I want to be by my kids. It's more expensive than I thought. You could put down less money, like say it was a $100,000 house. You could put down.
Way too low. Let's say it's a $500,000
Well,
house.
Angie, 100 is easier for me to do the math.
Instead of me going and taking $500,000 and paying cash because I want to stay out of debt, I could pay $250,000 maybe or $200,000 down,
or 300 probably.
And then just go borrow the rest with no payment,
right?
Because my kids live in a very expensive area, kind of deal.
Yeah.
Yes. All right.
Prices are going up faster than my mathematical abilities.
All right, so basically what you want to do is you want to talk to your family, talk to your financial planner.
Yes.
Maybe even talk to your dog.
No,
but definitely
don't talk to your dog.
Talk to Glenn. Don't do it
thanks.
alone is the point. Talk to Glenn who knows about it, who can give you options, work through it with your planner, with your children, and figure out what might be best for you. You can look into it for free. It doesn't cost anything to have a phone call and work up some numbers and figure out if it's right for you.
And never, and I would never let anybody be high pressure on this. This isn't something you want to make a snap decision on. This is something you want to get the numbers, do your homework, and make a decision based on what suits you the best.
Like I said before, my mom got a reverse mortgage. It worked out great for her. Worked out fantastic and allowed her to stay in the home.
I had a couple in my office the other day, did one a year ago. It changed their lives for the better. They're overjoyed. It met all their needs. Yeah.
There you go. Well, thanks for joining us today. I
More
hope
fun
you
than
had
I thought.
some
Yes, I had fun
because it's a very mental process on the reverse mortgage.
Right.
Call Glenn over at Guild Mortgage and figure out if it's right for you. And we'll see you next week.
Thanks.